If you spend any time online, you have definitely seen a post like this. It's a frustration that goes viral again and again, and it hits a real nerve for anyone dreaming of owning a home.
And this is the heart of it, right? The math seems so obvious. You're thinking, hey, I'm already proving I can handle a higher payment every single month, so why on earth won't a bank approve me for less? It's a question that justifiably sparks so much debate.
It really feels like there's some secret piece of the puzzle that we're all missing. And that's exactly what we're going to do today. We're going to uncover what's really going on behind these numbers.
This whole situation actually has a name: the renter's paradox. It's that incredibly frustrating spot to be in, where you feel trapped paying high rent because you can't get approved for a mortgage that looks, on paper, so much cheaper.
So to get to the bottom of this, we're not just going to talk theory. We're actually diving into a real, massive online discussion where renters, homeowners, and even landlords were all hashing this out, trying to make sense of it. So, what do they have to say?
Let's start with the perspective that matters most in this equation: the banks. For them, looking at a rental application versus a mortgage application, well, they're not even in the same universe. And it all boils down to one single powerful word:
Risk. Yeah, that's the entire game for them. See, a bank isn't just asking, can you make the payment next month? No, they're trying to predict the future. They are calculating the statistical odds that you can make that payment on time every single month for the next 30 years.
And this comparison just lays it all out perfectly. On one side, you've got a 12-month lease. That's a low-risk, super short-term agreement. If a tenant defaults, sure, it's a headache for the landlord, but we're talking about a few $1,000s at stake. But then you look at the other side, a 30-year mortgage. That is a massive, high-risk, multi-decade loan. Now we're talking about hundreds of thousands of dollars. And if the homeowner defaults, that is a very, very big problem for the bank.
You know, this person on Reddit, CN8YLW, just absolutely nails it. When a bank says no, it's not personal. It's not an insult. It is a cold, hard statistical calculation. They're not worried about you making payment number 1. They're worried about you making payment number 281 20-some years from now.
Okay, so that's the bank side of things. It's all about that long-term risk. But there's a whole other side to this puzzle that so many of us miss, and it's all about what that mortgage number actually represents.
And this right here, this might be the biggest aha moment in the entire conversation. This quote from Redditor Bork the G says it all. Rent is the most you'll pay per month. Mortgage is the minimum you'll pay per month. Just think about that for a second. Your rent is your ceiling. Your mortgage, that's just the floor.
So let's go back to that number from the original post, $950. Sure, it looks great next to $1,400 in rent, but honestly, that number is incredibly misleading.
Because that $950, that's only the principal and interest on the loan. You still got to add property taxes, which can be hundreds of dollars. Then there's homeowners insurance, another couple hundred. And this is the big one. You have to be putting money aside every month for maintenance and repairs, because trust me, things are going to break. And just like that, when you add it all up, that cheaper $950 mortgage is actually a real-world cost of about $1,700 a month. All of a sudden, it's $300 more than the rent. That is the number the bank is looking at. And listen, that's just the stuff you can plan for every month. The real financial gut punch of owning a home comes from the giant, out-of-nowhere expenses, the kind of thing a renter just gets to call their landlord about. I mean, check out these real-life stories from the discussion. David Random buys a house and bam, needs a new roof. That's a $17,000 surprise right out of the gate.
Or how about this one from Appointment 45? The septic system goes, that's 20 grand, out of pocket. There's no one to call for help, that's all on you. And they weren't even done. The same person then had to replace their windows for another $29,000. See, when a bank denies a loan, this is the kind of financial shockwave they're trying to protect both you and themselves from. It's also the kind of shock a landlord has to be ready to absorb.
So all of this raises a really logical next question, right? If owning a home is so ridiculously expensive and risky, how on earth are landlords making any money?
I think most of us have this picture of a landlord just collecting the rent check and pocketing a nice profit every month. But as it turns out, the reality for many of them is the complete opposite.
You know, a bunch of people in the discussion pointed out that many landlords are actually losing money month to month. They're not playing for monthly cash flow. They're playing the long game. They are making a bet that the house's value will go up over many, many years. So they eat the monthly losses. They take on all those crazy maintenance risks, all in the hope of one big payday when they finally sell the property, maybe decades down the line. Now, there's one more really crucial point we have to address. A lot of people in that online discussion immediately called out the numbers in the original post.
And you know what? They had a good point. For most people in today's market, finding a house with a mortgage under $1,000, well, it sounds like something from a different decade.
But here's the thing, and this is really the most important takeaway from all of this. It doesn't matter if the mortgage is $950 or $2,500. The core principles are exactly the same. The long-term risk for the bank and all those hidden costs for the owner, those things don't change. So this leaves us with a totally different way to look at the whole situation. Maybe the real question isn't just, should I rent or should I buy? Maybe the question we should all be asking is, what kind of financial risk am I truly prepared and able to take on? Because as we've seen, they are two completely different